The Indian Rupee has recorded a historic fall against the US dollar this year. The currency has recorded a hard hit of depreciation by approximately 30% in last 10 years. Presently, it is hovering above 95 rupees per US dollar and has become one of the Asia's worst performing currencies. As a result, India is facing severe challenges including high energy import bill, a widening current account deficit, and high inflation in the domestic market. This market volatility is putting more pressure on India's forex reserves and slowing down India's growth trajectory. But this is just one side of the story. If we observe the other side of the story, it is more concerning and alarming. Petrol, diesel and CNG prices are increasing sharply, food items are becoming more expensive, and cooking gas and oil prices are also increasing. But the question is, what are the factors responsible for the weakening of Indian currency? If we observe the downfall of Indian Rupee, we will get to know that this fall of currency is primarily driven by four major factors. And these factors are rising crude oil prices, foreign capital outflow, strengthening of the US dollar, India's widening current account deficit. Let's start with rising crude oil prices first. If we observe the downfall of Indian Rupee, we will get to know this. This is not a new thing for India. It has already been losing its value against the major foreign currencies, especially the US dollar. The data shows that it is always hitting a new record low and slowing down India's rapid growth. But the situation started getting more chaotic and worsening further when the Iran-US conflict erupted in the Middle East. This crisis became more added fuel to the ongoing fire of currency freefall, because the crisis in the West Asian region resulted in blockade of the Strait of Hormuz by Iran. It was one of the most concerning shifts for India because majority of India's energy supply come from this region. After this major geopolitical shift, the global energy supply has disrupted and it has also affected India. It started hurting global economy, especially Asian economies, including the Indian economy. Because the rising geopolitical tensions in the region shook crude oil prices and they started skyrocketing in the global market. This became a nightmare for the Indian economy, especially for the Indian Rupee. Because when oil prices rise in the global market, the oil companies need more US dollars to buy crude oil from the international market. Therefore, Indian importers sell more Indian rupees to buy US dollars to make payments for oil purchases globally. In this situation, the market gets flooded with more Indian rupees, leading to weakening of the Indian Rupee. This market shifts put downward pressure on the Indian Rupee by creating a demand and supply imbalance in the foreign exchange market. The second reason is the foreign capital outflow. If we see the growth story of the Indian economy, it is often celebrated as one of the best economies in the world. As we all know, it is one of the fastest growing economies in the world, which makes it one of the promising and rewarding market destinations for investors. These foreign investors make huge investments in the Indian market to maximize their profits and multiply their money. As a result, these attractive features of the Indian economy make Indian economy vulnerable to global shocks. Because when these investors prefer to exit the Indian market in search of good profits from other alternative markets, it indirectly affects the Indian Rupee. This is already happening in the Indian market, and this can be understood through the changes in the domestic market. Despite being one of the fastest growing economies in the world, the Indian economy has seen a major changes in the market, and one of them was the exodus of the foreign portfolio investors. If we observe the numbers, we will find that India has lost approximately 2.22 lakh crore rupees in 2026 alone. It is roughly 23.6 billion US dollars and a massive amount of money in the last 5 months. The changing geopolitical landscape and India's market volatility forced foreign portfolio investors to withdraw their money and leave the Indian market. This is a concerning situation for India because when these investors leave the Indian market, they sell their stocks and bond assets on a large scale. This aggressive selling and convertibility results in high volatility of the forex market. As a result, this aggressive dumping of the Indian rupee and high demand for the dollars in the foreign exchange market put severe downward pressure on the Indian currency. These market shifts weaken the Indian currency, which is already depreciating due to high import bills of crude oil, gold and silver, and raw electronic items from the global market. The third reason is strengthening US dollar. The US dollar plays a significant role in the international market because it serves as a global anchor currency. It has emerged as a safe haven currency in the world as it is backed by a strong and powerful economy in the world. Nearly 90% of all foreign exchange transactions are processed in the US dollar. Therefore, the currency enjoys a status of a universal global currency. When the US Federal Reserve maintains high interest rates and the US Treasury bonds offer high risk-free returns, investors flock to the US market. And it gets more flooded with investors when the global market is volatile, the inflation is very high, and geopolitical friction is at its peak. If we observe the present free fall or depreciation of the Indian currency, it is primarily driven by a massive geopolitical shift and change in world order. Moreover, a strong US dollar, a promising and stable US market, and an effective policy framework by the Federal Reserve are also attracting the investors. Now let's know the fourth reason, that is widening current account deficit. But before understanding this reason, let's understand what is current account deficit. When countries trade in the international market, all of these countries record their transactions in the balance of payments. It is maintained by the central bank of every country as per the IMF guidelines. The balance of payment is a systematic record of economic transactions between the countries for a specific time period, and that reflects countries' financial health in the international market. There are mainly two components of balance of payment, and these components include current account and the capital account. When the current account shows negative numbers, it is called current account deficit. And when the capital account is showing in the negative numbers, it is called a capital account deficit. If we observe India's condition, India's current account deficit is a structural problem because the Indian economy is heavily dependent on crude oil imports. It means that India is spending more foreign currency on imports and external payments than it is earning through exports. Moreover, the recent exodus of foreign portfolio investors has also become one of the reasons for the plunge in India's US dollar inflow. The present market changes have created a concerning situation for India because these market conditions create a short supply of US dollar and an excessive supply of the Indian rupee. This puts even more downward pressure on the Indian rupee, leading to weakening of the Indian currency.